Hello, and welcome to the Geopolitics Explained podcast. For the last few weeks, we've been discussing the UK and their financial and political reality. This discussion has come in the aftermath of the Labour UK budget that we saw on the 26th of November. Due to a lack of confidence in UK bond markets after the 2022 Liz Truss mini budget, we have seen Labour introduce two non-negotiable fiscal rules in an attempt to incite confidence back into UK debt markets. The implementation of these two non-negotiable fiscal rules is an attempt to maintain stability, since every budget since 2022 has been constrained by this lack of confidence. Both of Labour's rules require stronger economic growth and stronger productivity. If this doesn't occur, then increased revenues that these rules require will ultimately have to come from higher taxes. In today's discussion, we'll explore if the UK can find greater economic or productivity growth, or if low growth is ingrained in the UK and if higher taxes will be needed. When I think of the UK today, I question what it's known for. The UK was the former master of the seas, one of the strongest naval powers in history, but since the end of World War II, the country has been in relative stagnation. Manufacturing has been exported, and years of austerity have left public services underwhelming and insufficient. This has negatively impacted productivity. Worryingly, the OBR has typically been over-optimistic with its productivity growth estimations, which have slowed dramatically since the 2008 Great Financial Crisis. The central forecast for underlying productivity growth in the medium term is 1%, as per the OBR. This was downgraded by 0.3% from March's forecast. This is positive productivity growth, albeit at an incredibly slow pace. When we look at the debt situation in the UK, the debt burden currently sits at around 95% of gross domestic product. The last time the UK was at this level was in the 1960s, when this debt burden was actually falling due to a post-World War II economic boom. The growth in this period was between 2.7 and 3% on average, and this is growth that the UK would dream of possessing today. This growth during this period of the 1960s notably still lagged behind growth in continental Europe, which averaged between 4 and 6%. It is questionable if UK stagnation was already baked in post-World War II. The main reasons for this slower growth were reduced capital investment, productivity issues, lingering imperial commitments, and a balance of payments crisis that stunted sustained growth. The UK was a former empire that had overstretched, and it was seeing this reality come to fruition as it was outpaced by other geopolitical powers. This ultimately remains a reality today. So, if we flash forward to today, where is this stagnation clear in the UK economy? Well, government spending on existing debt interest has more than doubled since 2020. To make matters worse, borrowing costs have increased since 2021 due to higher interest rates. This means that any new debt that is issued is more expensive. A worry from the most recent budget is that short-term borrowing actually increased due to spending pressures. In order to bear down on borrowing costs and to meet the stability rule, the Chancellor needs economic and productivity growth. Otherwise, she'll be relying on further tax increases to raise revenues. Unfortunately, for the UK, there are some forces that are hindering economic and productivity gains. The first is demographics. The demographics in the UK aren't as bad as in other nations, but the fertility rate of 1.41 in 2024 is well below the replacement rate. The replacement rate is the rate required to maintain a stable population, and this sits at 2.1 children per woman. With the fertility rate being below replacement rate, this sees an ageing population emerge. This sees pension and healthcare spending pushed upwards, and this makes meeting the fiscal rules even more difficult. At the same time, debt interest costs continue to remain elevated. If a fiscal deficit is maintained, then the gap between spending and revenues will be made up by borrowing. At a time of elevated interest rates, this makes the problem worse, and more will be spent on debt interest. If this is not addressed, this can continue to spiral, especially in environments with elevated interest rates. As a result of this lack of confidence in UK debt, a credible plan is needed to reduce government borrowing and to increase revenues. The question we'll now explore is where greater revenues can be found in the UK economy that can take away the burden from tax rises. The UK is largely a services-based economy, with around 80% of its total economy size made up of services. But in recent years, it has suffered from lower business investment as a result of Brexit and years of austerity. Low investment reduces capital per worker, and this typically slows new innovative technology that could boost internal productivity. This is detailed in the Solo model, and the consequence of low investment is long-term growth stalling. To address this long-term issue, investment must be directed to the best areas of the economy to boost productivity today. With the services sector being such a large portion of the economy, the sector could see productivity gains from increased digitalisation, automation, AI, and organisational redesign. But this would have to be applied correctly. Otherwise, the risk would be that the opposite effect could occur, and that this would generate low quality outputs that would actually decrease productivity. To support this with some data, between the Great Financial Crisis and 2022, services productivity grew 4% in the UK. ICT productivity, on the other hand, grew 150% in the UK. Output per hour in the services sector has also remained relatively flat since 2010. Some segments of the economy may now be hitting smaller productivity returns. This is typically consistent with innovation being highly concentrated in a small collection of large firms. To address this concentration issue, a productivity lift in the UK would require an approach across geographies, sectors, and firms of different sizes. But with the relative underperformance of services productivity growth, this would be one area in which I would focus. If we look at other sector-based productivity improvements, a theory is that lagging sectors that have seen productivity declines or underperformance in recent years start from a lower base, and so, in theory, they should offer the largest gains. But there is a nuance here. This is only valid if these sectors are technologically transferable. As technology moves on, investment in declining sectors is unproductive. We saw during COVID that logistics is transferable online. As a result, online retail platforms captured the gains, while physical retail declined. Deep investment today in physical retail would be considered unproductive. But it is notable that a nation should still invest in sectors important for self-reliance, even if these sectors are experiencing decline in productivity. This is typically seen in the UK in sectors such as mining and manufacturing, for example. These sectors might lack strong productivity metrics, but they underpin resiliency and national security in a world that is growing more geopolitically tense. If we move on to focus on geographic productivity boosts, there is a clear productivity gap in the UK between London and the rest of the country. Big firms in London are at the forefront of productivity and innovation, but other firms in the UK of different sizes and geographies typically underperform the nation's average productivity. As a result of this, a national effort is required, not one that is just focused on London. After all, the biggest productivity gains geographically in the UK are likely going to be found outside of the capital. As a part of the UK budget, £13 billion was set aside for the mayors of Greater Manchester, West Midlands, Liverpool, West Yorkshire, the North East, South Yorkshire, and Greater London. This is likely an attempt to reduce this gap. For anybody who has travelled to Leeds recently, you'll see the pace at which they are constructing new high-rise buildings. Leeds is the second largest financial centre in the UK behind London, and it is attracting graduates who don't wish to move down to the capital. This is focused investment in a geography and sector where clear gains can be found. Other areas where productivity gains could be found that I won't discuss in extreme detail are the UK's energy and industrial strategy, in UK apprenticeships and skills-based education that will in turn boost domestic manufacturing, and in extra support for small and medium-sized firms. As a part of the UK budget, policies in all three of these areas were included. The years of austerity in the UK saw a lack of public investment and long-term industrial policy. Labour hopes that investment in these areas will transform positively into productivity gains. More importantly, the hope is that this will diffuse across firms of all sizes, geographies, and sectors. The most important question here is if this can become a reality. Low productivity in the UK isn't baked in, but it is policy sensitive. A lack of investment in public services will see them decay. This hurts quality of life. Now, investment can be aligned with skills, geographies, and sectors in the UK, but it requires a coherent long-term policy. Unfortunately, this takes years to become visible, and that's if it even works. Many roadblocks still remain. One such roadblock is the financial situation in the UK. This is because if revenues don't increase through productivity gains, it will have to come from taxes. This is politically damaging and it further hurts quality of life. As a result of both productivity and financial situation limitations, politics in the UK is under pressure. The current trend of Labour's leadership and their political standing is negative. These changes from the budget are aiming to increase productivity, and they are promising, but this ultimately came at the cost of higher taxes. This has political costs. If citizens see their quality of life declining as a result of low productivity, and if they see tax rises and they see less money in their pocket at the end of the month, then they're more likely to want political change, since this is one of the areas in which they have control through their voting. It ultimately doesn't matter how promising a plan to boost productivity is when it might lack the time to become a political reality. Now, I don't believe this is the flaw of the politicians making the decisions, and it's certainly not a flaw of the people who vote. I believe it is a systemic problem, which ultimately is difficult to address, again, as I stated earlier, without a long-term coherent policy. This ultimately could require some cooperation across governments. Now, despite me believing that this is a promising plan, this isn't to say that this is the only plan that could boost productivity. But it is the lack of consistency with a single plan that continues to hurt the UK financially and productively. This restricts the UK politically. and until a long-term mindset is maintained across a long period of time, this reality will remain. Things might get worse in the UK before they get better. And to get better, people in the UK would likely have to pay a price for an extended period of time. This is what the Chancellor means when she asks everyone to make a contribution via higher taxes. This plea from the Chancellor is unlikely to shift political attitudes in a positive direction. The Labour approach here is one of attempted balance by continuing to increase spending, but seeking to increase revenues more. It's risky, but if the UK is to dig itself out of its hole of stagnation, it needs to reduce the debt burden and borrowing, while at the same time pursuing public spending, energy security, productivity growth, and economic growth. For now, this boost to revenues is set to come from taxation. This is contributing to the £22 billion of headroom that is forecast to be available in 2029. This headroom has risen by £12 billion, more than in the March 2025 forecast, and it is seeing some confidence return to UK bond markets. Bringing inflation down and hence cutting rates over the coming years will see bond yields drop further. The important metric to monitor on this front is whether the yields maintain the more on premium in comparison to other bonds, especially European bonds. Time will tell if the UK will, in reality, experience productivity gains, or if it will continue to lack the multi-year consistency that is required to address these issues. For now, the plan does remain in motion. That's all for today. Next week, we're going to return to the United States and the repo markets. We did discuss a few weeks ago how quantitative tightening in the US was reducing liquidity in repo markets. Just a few days ago, we saw the Federal Reserve state that they would restart net asset purchases of around $40 billion per month. This was expected, and it has been implemented to address declining liquidity in repo markets. On Tuesday, we will dive more into these details and look at the future direction of the United States' financial system. If you enjoyed this episode, please consider leaving a review on the podcast platform of your choice. It really helps out the podcast. I've been Dylan, and I'll talk to you next time.